India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call, coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Lata Venkatesh, and with me, guess what? Not just Rima, but also Nigel D'Souza. As you can see, bright and fresh from his go on holiday.
Well,
it's so good to have you back, Nigel, and wish you a very happy new year.
Well, thanks, Rima, as well as Lata, and so good to be back as well. I honestly didn't miss any of the market action. And from the time I left to the time I've come, the market has moved only around 150 points, a little bit higher. Yeah. But good to be back. Wishing everyone a very, very happy new year. Health, happiness all through the year.
Well, actually, even if you had gone in June and come back today, the market has not gone anywhere.
That's true.
So, actually, we were kind of lonely in the planet, if you please, yesterday. So there wasn't much action. Today, we will get more cues, but at the moment, we have really no global cues, as it were. If you can look at the Asian indexes, even they are kind of lingering. You can't say much about a third of a percent here and there. As well, the dollar index remains above the 108 mark. But I think domestic cues, one of them is really important, and that is the GST tax collections in the month of December are up only by 7.3%. Now, I'll tell you why it's bad. About 5% is accounted for by inflation. Inflation on an average has been running at 5.4. Even if you take out vegetables, which are not under GST, you're still running at a 4.5%. So if you take that out, the actual volume growth is only 3%, which shows poor consumption. GST is an excellent indicator of consumption. I would worry about that. And of course, auto sales, Rima has taken us through yesterday, a better part of them. And I would want you to update us, but they were also mixed. Two-wheelers, in particular, the mass consumption item, hasn't done well. And finally, I looked up the NMDC numbers, and I'll await more nuances from you. That, again, is a negative in terms of sales. So I think the early December numbers are not looking too good in terms of consumption.
Okay, but let's just do a quick recap then of the action then. So most of the Asian markets will resume trade today, and the early rates are negative. So Hang Seng is down over 2%. Shanghai slipped close to about 1%. Taiwanese markets are down 0.5%. It's only Japan which will continue to remain shut on Thursday and Friday. Now, yesterday, we closed with marginal gains of about 0.4%. The Nifty ending closer to 23,740. But as you can see, the small cap index outperformed with a gain of close to about 1%. But broadly, for the last many days, we still continue to remain in that range, 23,500 on the way down to up to 24,000 on the way up. In terms of flows, yesterday, the DII's net bought 1690 crore. The FI's net sold 1780 crore. But what is important to note are the kind of gross volumes and compare it with what we've seen and the way they've dwindled. So on Monday, the FII gross and buy and gross sell was close to about 15 to 17,000 crore. That came down to a trickle, just about 1,200 crore of a gross buy and about 3,000 crore of a gross sell. Even for DIIs, on Monday, the gross buy and gross sell was close to about 40,000 crore. And yesterday, we were looking at about 8.5 and 6,000 crore rupees. So in a nutshell, it was a very low volume, languid kind of session. So even though we had a gap up, we had a positive close, should we read too much into it? And does it have further legs? But now that everyone's back at work, it's time to talk about earnings. That's going to be the big cue. And this is the earnings calendar for the next, it starts with 9th of Jan, TCS, but I've put it up for the next 10 days beyond that. And you've got important ones like HDFC AMC, Angel One, HDFC Life, and many IT companies like LTTS, Infosys, etc. reporting numbers. And Nigel, not to forget, right, today you've also got the weekly expiry.
Well, that's right. The weekly expiry was something that will keep things volatile. And for me, the big cue really has been the dollar index. From an emerging market standpoint, that one strengthened. Until that, cools off a little bit, it'll be difficult to see whether or not the flows can come back. So the dollar index strengthening, That's a bit of an issue. 108.5, that's too strong for my liking. So we'll have to see some kind of cool down here to hope that flows return back. In terms of the FI action, as you said, volumes very, very low. They were net sellers. And in the futures market, they've added short positions. So they've added close to 14,000 contracts. Participation still was low, though way more shorts than long positioning. And if you look at it in absolute terms, the percentage terms, 86% of the positioning is on the short side. You'll say that, well, we need a positive trigger and we'll see a bit of a short covering bounce. That's very, very possible because the net short positions at around 2.3 lakh contracts on the short side from the FIs itself. But today is going to be weekly expiry, so we'll be looking at a couple of options and a couple of strikes out there. The 23,750 call as well as put, well, that was fairly active. And you club the premium between these two, it'll be closer on 250 rupees, which tells you there's a possible strategy at place, which is a short straddle. What is that? You write both those two strikes, you pocket the premium of around 250 points, and you hope that the Nifty stays in this range of close to 500 points. That's 250 plus, 250 minus the strike, which is 23,750. So that's the broad range. I'll tell you what, if you can get a little above yesterday's high, that's going to be important. That could help you move to around the 24,000 odd mark. But there is resistance coming in at around 24,100 odd because the 20 as well as the 50 DMA comes in that vicinity as this chart tells you. So the FIs are net short. We need a positive trigger. We need to see some kind of cooling off with regard to the dollar index. And that's what could trigger a bit of a short covering bounce. For the time being, it appears we're in a bit of a range. Stocks that I'm looking at, well, Jubilant FoodWorks. Yesterday, we have been talking about volumes being relatively low. But the stock ended at the high point of the day. It's crossed that 20 DMA, which is at around, close around the 690 rupee odd mark. The stock yesterday appeared that it's good for more. We had a bit of a short covering, as I said. Open interest was lower. And on the day that volumes were lower for the overall market, well, the delivery volumes of Jubilant FoodWorks was much higher than what we've seen in the previous 10 sessions. So I think we'll keep an eye out on this one. Festivities, maybe the street is sensing a bit of a positive showing in the coming quarter. So that's the one that I'll look out for.
Okay, thanks a lot for that, Nigel. I take your point. The dollar index is what we have been bemoaning, even in your absence. It did go to 107.98 for one day in the last week of December. But otherwise, it has remained above 108 and it closed on 31st in the US, suddenly at this 108.4. People have not made much of it because it was thin trades at that time and it is stuck at that 108.49 till, the trading starts in full fury today. The impact on the rupee was not very severe. We saw the rupee, of course, decline. It's been declining for the last many months. But it's definitely going to be a pain point. And that explains why, in spite of the very thin volumes that you put up on the board, it was still a 1,400 crore sell yesterday. The algo trade is so clearly in favor of US exceptionalism as long as the dollar is strong. And by the way, the US yields are also at 4.5758. So, it makes so much sense to be in a risk-free trade like the US bond.
Well, and we're talking about this winning streak that we've seen for the last 9 years or so. And we're hoping that we get the 10th year. But there are plenty of challenges ahead for this year. But I'll just give you one data point. I was looking at a Samco note and they said in an odd year, the Nifty does better than an even year. That is 2025 is the end. So, data proves that actually in an odd year. So let's see whether or not it is clashing onto some stocks and some kind of positives, but that was the note that came in yesterday.
Okay, well, I'm a little worried till I see consumption back on the table, and that's why I keep looking at auto sales and I keep looking at GST numbers, which indicate consumption. Okay, let's get you the equity call of the morning. Pankaj Chachoria of Antique Stockbroking believes that valuations, that is of Nifty 200, are still reasonable at 21 times 1 year forward EPS. He says valuations for non-financial companies appear marginally stretched at 26 times 1 year forward EPS, even as financial sector struggles. He believes that this trend will sustain in calendar F25, given strong growth outlook for manufacturing and capex sectors. He remains meaningfully overweight on capex, industrials, defense, power, renewables, real estate, and cement. He's underweight on financials and FMCG, while neutral on IT, automobile and pharma. He projects Nifty EPS CAGR of 15% over FY25 to 27 estimates, of course. And his March 2026 Nifty target stands at 26,500 based on a 19 times FY27 estimated EPS.